Netflix stock is down 35% after they reported earnings last night. Is the stock a buy at these levels? In the next 5 minutes, we're going to review the key highlights from the company's earnings report. I'm going to tell you 3 reasons why I am personally not interested in buying Netflix, even at these levels. And I'm going to tell you one stock that I personally own and I think is a better alternative to Netflix moving forward. As always, I want to start by showing my real money portfolio that I'm building from $10,000 to $1 million over the next 10 years and sharing every step of the way here with you on YouTube. As you can see, portfolio is down about 2%. We're at a total value of $24,300 and we have put in $25,000. So in total, since February 15th, we're down $648, down 4%. I've said it before, I'll say it again, not at all concerned with the portfolio being down at this time. And in fact, I hope that it continues so that I can keep buying more shares of great companies because I don't need this money and this portfolio is for the next 10 years or more. We'll just take a look at kind of what's moving on the day, and we can see that pretty much everything growth oriented in the growth bucket is down. The biggest loser is Twilio and Shopify. Not sure if there's news on Shopify. That's down about 9%. I'm not making any changes. Nothing has changed with these businesses and the underlying businesses that I own in the last day. I'm just simply looking at this and not concerned at all about making any changes. What we'll notice is the part of the portfolio that's up is the dividend side. And I've talked about purchasing Lowe's as one of my most recent purchases, and it's actually the largest position in the portfolio. And just today, it's up 3%. Advanced Autos up 2%, and really everything on the dividend side is up. So clearly, it's a day for value / dividend paying type stocks over growth. And then crypto is down slightly. I just own some GBTC and ETHE. All right, that's the portfolio. Again, not making any changes, but just sharing the portfolio transparently. Let's jump into the Netflix report, and we'll talk about what management said that's causing a lot of the drop in the stock, in my opinion. And then we'll talk about a few reasons why I'm still not interested in owning Netflix. And again, at the end of the video, I'll share a stock that I like better personally. This is Netflix, their shareholder letter. The company shares this every time they report earnings. You can go to, if you just Google Netflix IR, Investor Relations, you can go to earnings reports or quarterly results, and you'll be able to find their shareholders letter. I'm just going to read this part because the tone is very different from what we've heard from management before, and it's pretty negative. Revenue growth has slowed considerably as our results and forecast below show. Streaming is winning over linear, as we predicted, and Netflix titles are very popular globally. However, our relatively high household penetration, when including the large number of households sharing accounts combined with competition, is creating revenue growth headwinds. If you notice, if you watched the video yesterday on Roku, I actually talked a little bit about competition and why I don't necessarily want to own Roku right now either, because of some of those competitive dynamics. So check out that video after you're done watching this one. So a couple key things to highlight in that first paragraph are relatively high household penetration. That right there is management basically admitting that they are getting near the top of what they think their penetration could be, and that growth is going to slow in household penetration. And if that happens, that means the total possible subscribers that Netflix is expecting could be a lot lower than what we've heard from management in the future. That's the first thing. Management also alluded to households sharing accounts as an issue. They've talked about this a little bit before, but previously it didn't really stop their revenue growth or their household penetration. Now that penetration and growth is slowing, they're pointing this out as an issue. Their strategy is going to be to try and stop that from happening. And what management thinks is going to happen, and a lot of other people believe is going to happen, is they think that those people that are sharing accounts are going to end up signing up for their own account. 10 years ago or 5 or 7 years ago, that was likely when Netflix was really the only game in town in terms of quality streaming stuff. But now there's so many other options. And if somebody is not wanting to pay for Netflix themselves and they're sharing their parents' account, maybe they're off at college or a family is sharing, the person that doesn't own that account is probably a lot less likely to actually sign up and want to pay than the person who owns the account to begin with. So I don't think we can easily say that because they stop allowing people to share accounts, they're automatically going to get a lot more signups, especially as they're raising prices. So that's the second highlight from this earnings report that's very concerning. The third one, and this is huge, is that for the first time, and I think the last decade or so, they lost subscribers quarter over quarter. So if we see here in Q4 2021, they had 221,840,000 subscribers. In Q1 2022, that dropped by 200,000 subscribers to 221,640,000. If that was a one-time thing, they might get by. But we could see their next quarter forecast, and they're actually projecting to drop by 2 million subscribers next quarter. So that raises some huge questions. Why are they expecting that? What are they seeing? That if they're changing the sharing pricing dynamics, you would think that they would be expecting more subscribers, not less. So they're clearly seeing a lot of competition, maybe not just from streaming providers, but also from other places that people might be spending their money on things more important to them than, say, streaming or Netflix. And here's another big one that wasn't called out in the shareholder letter, but that management talked about on the call. They are moving towards an advertising model. So traditionally, Netflix has never had an advertising tier. It's always just been paid. What management is talking about is having probably a fully paid tier, but then also an ad-supported tier where you probably get a discounted rate, and then you see some advertisements as well. That takes potentially a lot away from Netflix. A lot of people like Netflix because there's no advertising. And so then the question becomes, how many of their fully paying subscribers are they going to keep? How many are going to switch to this ad-supported model? And are they doing this because they're almost admitting defeat and they see that they're almost fully saturated? They're getting concerned about the amount of households they can grow into. Why are they opening up to this ad-supported model now? And why didn't they do it during a time of strength? Why are they doing it during a time of weakness? Those are the questions that come into my mind. We've jumped over to fast graphs, and so now we have to transition. Okay, this happened. The business has gotten a lot cheaper. Shares are down 40%. Are we interested in potentially purchasing the business? I'm not. Because the fundamentals and the execution of the business have gotten weaker. And anytime that happens, I don't think that I should want to jump in and own a company on weakness just because the price is down. If I didn't like the business when it was stronger, I'm not going to like the business when it's weaker. I'm not saying I never will, but I'm definitely not interested in jumping around right now. What's going to change in the next 30 days or even 6 months for Netflix that's going to shift the business back to that growth stage? And right now, the information I have, I'm not seeing anything. So then we have to say, like, okay, is it at such an extreme discount that you're crazy not to own it? Some might argue that Netflix is. But if we look at the history on a price to sales ratio, we see that the average over the last since 2009, their sales growth rate has been about 23%, and their normalized price to sales ratio has been 5. So right now it's at 5.6, and sure, it's way down, but their price to sales ratio got way out of whack, and it was trading almost at double from where it had really almost ever reasonably been, other than back in 2008, it got way up there as well, but their growth was a lot faster for the next few years. And so if we look back, and this is back where there were some potential competitive questions for Netflix, you know, the price sales ratio was 5 back in 2015, down to 3 or 4 in 2014, and even down to 1 and 1.5 in 2013. So that's probably an extreme. But I think, you know, a realistic place is, you know, somewhere from 3 to maybe 6 on a forward price to sales basis, just based off the company's past performance and execution. The sales growth rate over this time has been 23%. So if we go to forecast and we're expecting sales growth to slow down, it's almost half of what it was, then it doesn't deserve the same price to sales multiple that it previously did. If we take this out based on forecasted numbers, which are probably going to come down after this earnings report. So yeah, sure, the stock price is lower. This is just reflecting before the close yesterday. these growth expectations are also going to come down. So that'll combat that a little bit. So if we take it out to 2024 at a price sales ratio of 4, we're only getting an annualized rate of return of 5 at that point. And so with the business weakening, I don't personally want to own Netflix right now, given that it doesn't seem like there's a crazy risk reward to the valuation multiples that I think make sense out over the next few years, when there's so many other companies that I can own that are executing really well. And that's what it comes down to. It's not just about Netflix. It's about what else can you own and what else do you own. The trade desk is actually trading higher today. Well, why is the trade desk trading higher? The trade desk is trading higher because of that mention from Netflix that they're moving towards an ad-supported model. Jeff Green, the trade desk founder and CEO, has been saying this for years, that Netflix was going to do it. And Netflix, Reed Hastings was denying it. Well, now it turns out Jeff Green's been right all along. And so me personally, I own the trade desk, and I like the trade desk better than Roku and better than Netflix, because they're agnostic to devices. They're agnostic to a single service like Netflix. And they benefit from more people moving away from traditional television to connected and streaming TV, and then more ads being sold because they help facilitate the exchange, the buying and selling of those digital ads. And the other thing about the trade desk is it's a software platform. So if ads move from streaming TV to something else, theoretically, they've got the engineers, they've got the process to be able to make that transition as well, and maybe even help it happen. The trade desk is a small position for me right now. If you look, this is my whole portfolio on commonstock.com where it's tracked. The trade desk is only a 3% position. And part of the reason why is because I do think shares are a little bit pricey, and I would, before adding, because I think there's other better opportunities in my portfolio to add, I would want to see that price sales ratio come down a little bit so I could buy shares at more of a discount. I don't know if that's going to happen. Maybe it happens after the next earnings results. And if the business is still strong, then I would likely look to add shares if that happens and I'm getting a better valuation. Thanks so much for watching. Make sure you like the video so I know what type of videos to keep making for y'all. If you want me to review a company, leave it in the comments below and I'll do subscriber request reviews. And then make sure you subscribe to the channel so you never miss an update. I own Tesla. It's one of my largest positions. They report earnings this afternoon, so I will definitely be making a Tesla earnings review video no matter how those earnings go. Thanks again, and always remember, take care of your mind, your body, and your money.